Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0, News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Friday, December the 20th. It's a few days before Christmas. I'd like to wish everybody out there, all the people who watch the videos, and I thank you very much. Wish you a happy holiday season, Merry Christmas, Happy Hanukkah, Feliz Navidad, Joyeux Noel, or whatever faith you follow and subscribe to. I wish you a very merry time of the year, safe, and enjoy time with friends and families. Take some time off, enjoy the season, a little relaxation. I think we're all due for it by the end of the year. Now, in the real estate world, it doesn't stop. Actually, things are picking up the pace big time now. More and more off-market properties are coming my way. So if you're interested in taking a look at those in my area, drop me a line, hit me up with my email, give me your phone number so I can contact you. And these are primarily fix and flip opportunities, or fix and hold opportunities as well too. Again, for people who are serious, who are looking to to earn income or acquire a rental property, certainly speak with me. What we're not doing is allowing people to put them under contract and looking for an end buyer. We've already got it tied up. So if you're looking to possibly, expand your portfolio, get into investing, do some fix and flips, give me a shout. We'll see if we can hook you up. All right. Having said that, if you have not reached out to me regarding my advanced short sale training, other programs that I have, I'm offering holiday discounts. I know people have already jumped on the past couple of days, and I appreciate that. And we're ready to kick off the new year. I do think 2020 is going to be the year of the short sale. There's just not that much inventory out there, and what I teach is certainly a way to get at an untapped source of inventory for either real estate investment or retail buying. So there you go. And if you're not already a subscriber, please click the bottom right button there and subscribe. It certainly help my channel grow, and I do appreciate it. So the news of today basically boils down to very straightforward. It's NAR released their existing home price numbers for, I guess you could say, November 2019. So, last month, and obviously we're going to have a little bit of wind here. I just thought I'd go outside because it's nice out for a change. My little studio, by the way, is sort of being taken over for the next few days, and I also wanted to come out and wear my lovely Christmas sweater, which is I guess you could say, pays tribute to my little kitten, Bubble Kitty, who's not a little kitten anymore. So again, this is what I'm wearing for today. So there you go. Yes, it's an ugly sweater, and I'm proud to wear it. All right. So when we take a look at a lot of the articles that are coming up now, so existing home sales unexpectedly tumble in November despite lower rates. So that's, again, that sort of subtext or subtagline that we see all the time now. So why isn't the real estate market doing better? Why? Because lower rates out there shouldn't that allow more people to buy more homes and et cetera, et cetera. Well, guess what? We have an inventory process, an inventory issue, an inventory. We're short inventory, and that's the situation. So it's choking the sales. So ultimately, according to NAR's Vice President of Demographics here, America is facing a housing shortage and affordability challenges. Though demand remains solid, more inventory is needed at the lower end, and price reductions may be needed at the higher end as well. Now, last month's sales declined in the South, the nation's largest region, and purchases also declined in the West. We're looking at a 1.7% month-to-month reduction in sales between October and November. That's the numbers. We're still up year over year. We're up a little bit, and again, back to the whole situation of despite lower rates. So the question is, with the Fed now on hold with respect to lowering the rates, what's going to happen if they possibly raise them? So will that hurt the market for the upcoming year? I suppose it will, but this is our big talks right now. If we take a look at another article that's out there, home sales are choppy as 2019 comes to a close. According to National Association of Realtors chief economist Lawrence Yun, basically sales will be choppy when inventory levels are low, but the economy is otherwise performing very well with more than 2 million job gains in the past year. The median existing home price for all housing types in November rose 5% to an average of $271,000. November marks the 93rd straight month of year-over-year gains with respect to home values. Now, inventory at the end of November was 1.64 million units. That's down 7.3% from October and 5.7% from this time from November 2018. So we're certainly getting hit on the inventory side. This is the big discussion now. Unsold inventory sits at 3.7 months worth of supply, which is down from 3.9 months in October and down from 4.0 months from a year ago. that's our situation. So clearly, we're going to still see price increases because it's the old supply and demand equilibrium equation, right? People will pay more to get their hands on the properties if there's less supply out there, and we're seeing that right now. Builders who in the last video I talked about, had a 20-year, highest builder sentiment in 20 years. This is the home builders, not consumers, but home builders. They're probably licking their chops going, okay, if we keep seeing these lower inventory situations with existing home sales, then they're going to come to us because they've got no place else to go. So they're probably going, this is going to be a great 2020, but it still boils down to they got to get the product out there. So people have to be able to afford it, number one. Two, they got to build it and they got to sell it. And with respect to increasing costs of materials, increased land costs and entitlement costs, they got to roll the dice and see what's going on. So, I think the past sort of year, especially the past quarter, we saw builders doing lots of incentives to get people into homes. We'll see if that continues down the road, and we'll also see, because their home median home prices and sale prices were slipping as well too. We'll see what they do to try to bridge the gap between existing home sales price rising and what their price points are. So there you go. More information with respect to NAR. So again, the sales decreased 1.7% from October to November. All right, and I guess you could say that was not a good thing because they thought it would decrease a little bit less, so it sort of missed its target points here. If you take a look at regional breakdown, the Northeast grew 1.4%, and the median price in the Northeast was up 3.9%. Existing home sales increased at the strongest pace in the Midwest at 2.3%, and their median sales price is up almost 6% from last November. The South dropped almost 4%, so 3.9%, and but it was still, even though it was dropping, it was still up 3.7% from a year ago. So that it was dropping from month to month. The median price had a 4.8% increase from a year ago, and existing home sales in the West declined 3.5% from October to November, but we're up 4.8% from a year ago, and the median price in the West was up 7.1%. So again, we're seeing that even though some locations, small increases with respect to sales volume, but overall a drop negatively, and overall an increase in price points because of, again, the lack of inventory. So there you go. If you want to tag a little deeper into this, let's take a look at NAR's information, which I'll post actually the link in the About video section here. So for me, I look at certain segments. So I look at market conditions, which is who's buying the property. So first-time home buyers accounted for 32% of sales. It's down 1% from a year ago. Sales to investors actually increased up to 16% from 13% a year ago. Cash sales were down to 20% from 21% a year ago, and distressed sales typically were the same, 2% from a year ago, 2% this year. And I always mention distressed sales, just so we're clear. Distressed sales are made up of REO, so real estate owned, already foreclosed on homes that were put on the MLS, all right, and short sales. Now, out of that 2%, typically short sales make up less than half of that number. That's what I typically see every month, so it doesn't really change. Home sales by region. All the homes that were sold last month, 13% occurred in the Northeast. The West had 20%. The Midwest had 25%. The South always leads with 42% of all the sales by region. Housing supply at the national level. So we also see single-family homes volume decrease. We see the overall volume decrease, and condo and co-op volumes decrease as well too. So we are in a inventory crunch and crisis. There's no other way to say it. All right. So that's the scoop. Now, sales by price range. This is where it's interesting and not well for a lot of people. We basically are seeing only 9% of the sales were the 0 to 100K mark. The 100 to 250K price point had 38% of the sales. The 250K to 500K price point, 37% of the sales. $500,000 to 750K price point was 10% of all sales, and 750K and above was 6% of all the sales. So you can see where people are buying. They're buying typically in the sub 250K range. Obviously, we're seeing a lot of sales there. 47% of sales take place in that range. But the real issue here is the fact that that part of the inventory is suffering. So the percentage change from a year ago based on price range, so that 0 to 100K price point level, there was 16% less sales. They're just not there. Why? Because the inventory is not there. The 100K to 250K sales area, almost 3.5% less sales than the year before. And again, the reason being, that's the sweet spot. That's affordable housing. Everybody wants to buy in that. Everyone wants to buy to live. Investors want to buy to invest. People who purchase homes out, for foreclosures, etc., want to hit that market as well too, because it can support or can supply the majority of the people across the country. So that's where, of course, everything is hurting, and sales. We're seeing that's part of the problem, is that when you have less sales in that range, clearly people know that they can raise prices, and it just is a trickle-down effect. Everybody gets affected by that. So that's the situation with respect to NAR statistics for November 2019. So what does the future hold for us? Well, median home prices are still unaffordable in the majority of the U.S. So ATTOM Data Solutions released their information for the fourth quarter of 2019, and basically they're stating the fact that the median home prices for this quarter, when you take a look at classifying them as unaffordable with respect to the average wage earner, 71% of the counties that they analyzed were classified as unaffordable. So 71% of the median, when you take a look at median wage earners, cannot afford the median home price in their county. That's across 71% of the counties that they analyzed, which is probably the major metros across the U.S. So there you go. So it's very clear. So it's not even a secret anymore. People talk about numbers and how we're getting fake news and whatever, but the real deal is this: that wage. So even though we may have reportedly strong job growth and employment statistics, that's great. But if you're a pay count on the unemployment, that's wonderful. But if you're not making a strong wage, that doesn't translate into purchasing a house. So the issue is not unemployment numbers; it's wage. So you're not getting paid enough. Your wages aren't increasing in the same capacity at the same pace as home prices. So that's what makes life unaffordable. But funny enough, the fact that 71% of the U.S. counties that are unaffordable is actually a reduction from 73% from Q3 of this year, and actually a year ago was 75%. So we've actually gained in the affordability component of this analysis, which is kind of funny. But here's the reason why we have the slight decline in the unaffordable component. It's due in part to the year's dip in the mortgage rates. So how people look at this, and again, this is the way people like to spin the information, which I don't personally agree with. So if they say their house is more affordable, it's not because people drop their prices. It's actually the opposite. Prices either remain the same or they actually went up, but your buying power increased based on mortgage rate decreases. So when your mortgage broker or banker works out your what you can afford based on your calculations, when there's a little bit of drop in rates, that means your payments are less, which means it translates to, well, you can now buy this much bigger a house or more expensive a house because your payment is actually dropped or the rates have dropped, so it offsets that. So please please realize that things are not more affordable. They're just they just cost you. You're just paying a bit less out of your mortgage. You're still taking the same mortgage. Your buying power is slightly greater, but homes are not more affordable. No one's dropping the price for you. It's just a function of a financial calculation. And to me, that's always misleading when we hear that things are more affordable, because they're really not. So that's the scoop on that. So that really is, I think, the number one issue we've felt the past couple quarters in the housing market has been inventory. It's been a shortage of inventory. Less people are putting the house up for sale. More people are taking cash out with respect to equity stripping or cash out refis. And from my opinion, when they do that, that just means they're not going to sell because they want to access the cash, and they've probably decided not to put their home on the market for whatever reasons. So that's the situation there. We don't have the inventory that was expected from the baby boomer generation as of yet, because they are either aging in place, or they can't afford to sell, or they have either we'll say family members living with them who are older or who are younger, and they're forced to remain in their homes. So that's a situation here. We also have a lot more investors playing the marketplace that are buying homes, and are competing with retail buyers now for what's left out in the marketplace. So that's the situation of where we're at, which is not really that great. So we need a couple things to happen. We need access inventory. We need home builders to build more homes. and more affordable homes. Whether they can or not, that'll be determined as the new year comes on. We need to access other sources of inventory, which I always talk about: off-market inventory, shadow inventory. Really, it's the pre-foreclosure market via the short sale process to get at a lot of inventory. So, we talk about foreclosure fines and how those, like, that number is solid. It's increasing. It's remaining strong. But people aren't going after that marketplace. That's where the inventory is. We have multifamily buyers jumping in, multifamily developers jumping in, trying to be the back end supplier for all the need of housing. So they're booming away as much as possible. But it's not single family homes is what we need to get our hands on. That's the situation right now. We'll see what's going to happen in the new year. As far as a housing crash, people are saying, well, how are we going to see a housing crash? Well, it may not be a crash, but something has to happen. There's got to be price reductions. It's got to be more inventory somewhere, somehow, some way. We're trying to figure all that out. There will come a point in time where the average person is just too tapped out and they cannot buy a home. So that's where this is going. It's not a good scene. So we have to find ways to be innovative and work around it and get our hands on those deals that are out there and get them to the surface, so the average person can buy them and live happily ever after in their home, as opposed to paying, we'll say, paying huge prices for things that really shouldn't be worth that much. So having said that, again, I want to, number one, thank everybody for this year's, your views, your comments, your patronage. Really appreciate helping my channel grow. If you're not already a subscriber, please hit the subscribe button. I do appreciate that. Again, if you want to know more about real estate sales, real estate investing, how to get at that inventory I always talk about, drop me a line, send me an email, give me your phone number. So, ask me when we can, give me some times we can call and we can connect. I can talk to you about the program and how it all works and what the benefits are. There are people who've already taken advantage of it the past week. I appreciate them and appreciate their confidence in me jumping on, and they're going to be off to the races soon. So prepare for the new year. Get your stuff going now. Figure out what's going on in the marketplace. Get prepared to work out there to finding homes, and hopefully you'll be pleasantly surprised when you get the results. So once again, I will wish everybody a happy holidays, a Merry Christmas, a Happy Hanukkah, a Feliz Navidad, Joyeux Noel, and whatever faith you subscribe to. Again, have a celebration over the holidays, and we'll look forward to speaking with you sometime for the next week. Thank you.